Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. Joining me today would typically be the man himself, Mr. Michael Becker, the governor of real estate in the great state of Texas, but he is on another due diligence assignment. So you have me in the podcast today. So we're excited to talk a little bit about, I would call this hope, discussion on hope. And the person I brought in today that I think you're really going to enjoy is somebody that has a number of years of experience in multifamily, somebody that's been through a couple cycles. And we always learn something by people that have been through cycles in real estate, specifically multifamily, specifically in Texas, and really what that looks like. A lot of people are getting up in today's environment, maybe 2-3 o'clock in the morning, in hitting their heads a little bit about, how do I get more income? How do I raise my NOI? How do I keep the lender and the wolf from the door? How do we do better? And so a lot of people are fatigued. So I brought the wolf in. The wolf is coming through the door. So I have Dusty Wolf with Centra Partners Management joining me. Dusty, thanks for being on the podcast.
Thank you, Paul. Thanks for anointing me as the wolf coming through the door. I have to chuckle at that. So that I guess that's a double-edged sword at the moment, isn't it?
It is. And so a lot of people that don't know Dusty, I want to have you talk and tell a little bit about yourself, Dusty, and kind of give a little background in your history, what you do today, what you've done in the past. Let us get to know you a little bit better.
Perfect. Thank you for the opportunity. Well, let's start with the president. But as he said, my name's Dusty Wolf, and I'm the president CEO of Centra Partners. We're primarily a third-party management company based in Houston with offices in the Dallas-Fort Worth area. We have applied our success all over the state of Texas and some of the other surrounding states and been in business for about 40 years. So that's who we are today. How I got here was I'm a native Houstonian in Houston, one of 7 left in my age level. And I started out educationally as a civil engineer, and I worked for what was then called Houston Lighting and Power Company in the power civil engineering department, building roads and drainages. Had a little stint with Dow Chemical and as a salesman, if you will, for a while, and then kind of got into property management by default. I was working for a development company in Houston called OCCO, Mirror Chandler Company, and they were a developer. And I had sold a small business that I had, management company, to them. And I left Houston one day and flew to Chicago because I was dating my future ex-wife. And I got a phone call that I needed to come back to Houston immediately because I was being put in charge of property management. Didn't have a clue. So the learning curve for me was straight vertical. And that was in 1975. And I haven't looked back since. I went back to school, got some more lessons, got my CPM designation, and worked for several very substantial real estate companies. And in 1989, I started a company called Asset Partners, which purchased the Centra Group, which is based in Dallas. And because I'm a marketing genius, I took Centra Group and Asset Partners and called it Centra Partners. And that's who we've been for the last 32 years.
Yeah, you guys have had tremendous success. How many units do you guys manage today?
Currently, we're right at 9,500 units, but that expands up to 15,000. Sometimes it's 7,000. Our marketing team will tell you that when we do our job, we lose our job because we get the property to the point of their business plan, and it's time for the next guy to have it.
It's a job that's very tedious because if you do so well in that job, you're getting fired. Mm-hmm. And if you do so bad, you're getting replaced and then getting fired.
Yeah, the first one's the better part of the resume. The last one you don't want to talk about. But yeah, it's it's about a 50-50 chance that we will retain if property in a sale, and we understand that. One of the things I think I'm proudest of in Centra, and this is probably the whole part of the conversation we'll have today, going back to hope, is I'm a firm believer that what drives our success and anybody in the real estate business is the people they associate with.
Right.
It's the staffing, it's the professionals like yourself and your business, it's the vendors, it's insurance companies. I hate to give them any type of gratitude, but it's the attorneys that we seek counsel with. So the success is being surrounded by that kind of people. And I think the old story is if you think you're the smartest guy in the room, you're in the wrong room. I think that's what helps. And that when we get back to talking about hope, I think that's a big key of where that metastasizes from.
Let's talk a little bit about your history and the history of this business, apartment investing. As I said at the beginning, a lot of people are up at 2, 3 o'clock in the morning thinking of how they could do business better. A lot of people did not sign up for all this stress in their lives. Some people have referred it to me as sailing in a boat that the seas were very calm. Now the seas are not so calm and there's a hole in the boat. And now we're getting stressed out by trying to get the water who's coming in the boat to get out of the boat and keep going the right way. So I want to go take a look in history of apartment investing. And again, I started back in 1986. So I started a decade pretty much after you, but I really define it by a couple different cycles. And I would say one of the cycles that I saw that I think this cycle that we're in right now is similar is kind of the savings and loan crisis. And I want to talk a little bit about that. I want to kind of get your reflection on the great financial crisis of back in, say, 2010, 11, and then really about what's going on today. And then I want to kind of have you give us some idea about how long it took to get out of the savings and loan crisis, how long it took to get out of the great financial crisis, and what's your optimism about how long it's going to take for us to get out of where we're at today and where are we at on that journey. So give me your reflection about the savings and loan crisis. I mean, you were kind of in the epicenter being from Houston. I was living in California at the time. Dallas was part of the epicenter of the savings and loan like Houston was. Tell me, if people are not old enough to remember, kind of remind them. And let's have them remember a little bit about what happened prior to like 1987 and the tax change.
Yeah, that's exactly what happened. And I will tell you, just kind of parenthetically, most of the time I've seen downturns, and it was, as you said, 1988, 87, 86, up to about 1991. Again, in the early 2000s, and of course, in 2008, 9, and so on and so forth. Probably the first one we saw, I got the feeling the effects was in 1972, 73, if you were the oil crisis, which is probably way ahead of anybody else on some of this video right now. But the oil crisis, the cost of doing business, the cost of even going to work had a lot to do with where the properties were, the rents, and moderating that. But I think most importantly, and when I've been asked to talk about this before, was January 1986, and a gentleman named Dan Rostenkowski, who was a congressman from Chicago. As of January 1st, 1986, they re-identified passive income. And basically what that meant was people who had high net worth, who may had, for example, a car dealership, and they bought an apartment complex. You could take the loss from that apartment complex and you could offset your other income. Well, the government came in and said, no, you can't do that anymore. So two things happened immediately. All of a sudden, these properties had to make a profit. They had to be fiscally responsible, which prior to that, they really hadn't. And to be truthful with you, the profession of property management in real estate wasn't even really a profession. It was like an industry. It wasn't it's not what it is now.
Yeah.
We had to go from just not really caring, and not to be disrespectful, but most of the managers were single moms looking for a place to live, and they worked the office and what have you. Now you need to be professional. Now these properties had to make money. They had to be realistic, which because of that, Mr. Rostenkowski, you had to learn accounting. You had to understand costs of operations. You had to watch your expenses. And all of that is what started the S&Ls and the FDIC, which created the RTC, which is the Resolution Trust Company, where properties were being defaulted on. And our company, I worked for a company at that time called Sterling Equities out of New York. Starting in January of 1986, every first Tuesday, which is the foreclosure day in Texas, I carried an overnight bag to my office. I was going somewhere to take over a property somewhere because the owners not having that passive income availability to write off, losses, they were just turning the keys in. And so as all these properties started to default, and some had S&L loans and some were FDIC loans, the whole financial market just went toes up. And nobody knew what to do with it because nothing like that had happened. But nobody had a law like that before Mr. Rostenkowski did that.
Sure.
This was a watershed. It was a completely new idea or a new debacle that everybody was trying to learn at all at one time. You as a lender, not you personally, but the lenders, they didn't know what to do with this. They were having properties given back to them. They had loans that they thought were valid, or they had been valid to a certain point. You had property managers not knowing what to do because, oh my gosh, I have to make a profit now. And the staffs weren't trained properly. It was a completely different set of circumstances never before seen.
What happened in terms of values? So a lot of these properties that were really structured as losses, now they have to be profitable. What happened, right before they changed the laws? What were the values at that period of time? And in say 1988, 89, 90, what happened to the values of that? How far did they go down?
Probably 50%, Paul. Probably every bit of that. Because we were seeing, once we took over a property, we had to do the evaluation for, again, the lender or the FDIC, Fannie Mae, Freddie Mac. They had offices all in Dallas. I used to go to Dallas a lot back those days. They were trying to figure out what is this property worth now, virtually non-operating. NOIs, we didn't even talk about NOIs before that. I mean, I'm sure somebody did somewhere, but we didn't even talk about NOIs. So properties that may have been on the books with, let's say, a Fannie loan, they were on the books for, in 1988, $45,000, $50,000, which at that time was an outrageous price to purchase something, and probably was trading on, on a 10 or 11 cap. All of a sudden, that $50,000 property was going to trade for 24, 28, maybe $30,000. It's just unbelievable. So it was panic. It was chaos. Now, going back to you wake up at 2 or 3 o'clock in the morning, there was a lot of people waking up at 2 or 3 o'clock in the morning. We were probably all meeting at the Dunkin' Donuts for coffee at that time because it just hadn't happened before.
So what was the recovery? Again, how long did it take, and what do you think the recovery was?
Every bit of 4 to 5 years, from about 1986 until the early 90s. And it took that long to go through all the properties that were being foreclosed on or being sent back. What the lenders decided to do is they built almost an in-house brokerage company. So they were bringing brokers in. They were maybe hiring the M&M guys at that time or JLL to take on these properties and reposition them and remarketing them and creating net new loans. So their best deal was, we know we've lost this money, but we don't want to operate this. We're not in a position to operate these properties. We don't want these properties.
Yeah, the government did not want to operate the properties.
Absolutely.
They didn't want to own the properties. They didn't want to maintain the properties.
No, they didn't want the liability of the property.
That's right.
The insurance of the property, to deal with the little Bobby beat up little Joey next door, and what are you going to do about it? After probably the first 6 months to a year, they fast tracked just getting rid of the properties. And at that point, you started to see some of the values going up because now you had capital chasing good deals, which helped escalate the values back of the properties, maybe not to where they were before, but you started seeing some appreciation because of the economics of them.
Yeah. So from 1987 to probably about 1992, there really was no lending in the market itself. Their lenders were gone. The savings and loans were toast. Then it became the banks that were the lenders in the deal, and it took them a long time to get comfortable because there was so much inventory. And so we really weren't building any new apartments. So when you go out, look for apartments today, you see a lot of 1960s, 1970s, first part of the 1980s, and then there's a donut hole up until 93, 94 or so. Then properties started to be built again. It just became a per pound price that a lot of people came in to buy these properties. And because there was no lending, they bought them in cash.
Right.
So whoever had cash or could bring cash together, there really wasn't any syndications at that time. There was institutional buyers coming in to buy these properties. And there were our friends from the East Coast, the friends from the West Coast that were flooding into Texas. But there was not a lot of Texas money trying to buy these. There was a few high net worth family offices trying to buy it, but it really was a challenge. And then 93, 94, things started to get going. And then you saw what happened from like 93 to say 2005, Dusty. I mean, you guys began your company. And what year did you guys start?
Actually, we started Asset Partners in 1989. So
Okay.
we were still part of the debacle, if you will. But to go to
Sure.
your point about no money in Texas, Texas got hit, probably one of the worst states that got hit as far as savings and loans in the FDIC. And we had some First City Bank of Houston was a building I took over for the FDIC from the bank because they were expecting bank fraud. But what we learned is that the bank would go in, for example, this is how mixed up the lending was at that time. An FDIC agent would go in and do an audit. And let's say, Paul, you had a tract of land out in West Texas and you were making notes on it. It was just raw land, but you liked it. Well, the auditor would come in and look at that piece of land, look at your loan and go, well, this is not an income producing property. What's it worth? It's like, well, it's worth a lot to Paul because he likes it.
Yeah.
And they went, well, in our mind, this is a zero value property. There's no valuation to it. So if that was a $5 million loan or a $500,000 loan, they wrote that down against the bank and said, you've got $500,000 of zero value. And that's how most of the S&Ls and the banks, more importantly, lost their valuation. So there was not any money. And that's where you saw all the bank mergers. Probably every week somebody merged with somebody, but they were losing their credibility and their valuations. So you couldn't borrow money from Texas.
Yeah, it was crazy. Then we started to get out of that trough, and then we started to get some speed for the 90s going into the 2000s. We had a couple troughs, not so much in Texas, not so much in the Southwest, but some troughs, whether it was the internet bubble or so. But talk to me a little bit about 2005, 2006. How was business for Houston? How was business for Dallas in the apartment industry?
I would tell you, we pretty much had a lot of ego going into those years because once Texas, Dallas, Houston, Austin to a lesser state, and San Antonio has always kind of been mild, not too exciting, but good. Since we weathered the earlier turnaround, we always felt that Texas was running counter to whatever the national economy was doing. So if the rest of the United States was in the tank, we were better, and we had learned our lesson. We moderated the valuation, we moderated lending. We became, at least in the Texas area, more professional in the operations of properties. We've been through we're going to take it and sell it and flip it and do this, that, and the other. So we'd had those skill sets that none of us had 10 years prior. But then in 2005, 2006, this goes back to the downturn of the economy headed for 2007. We saw it coming in valuations. We saw cap rates changing. We saw the investment individual, and again, all that changing. And again, we were just egotistical, like this couldn't possibly happen again. But we all kind of saw the signs, and what had happened. It was hard to do. The one thing goes back is if you're kind of gristled and gray and have scar tissue like I have, I've been there before. And as much as I didn't like it, I wasn't afraid of it because I think we knew what to do. And we knew that there is a weathering period of this. Mm-hmm. And probably more importantly is the people who probably get up at 2 or 3 o'clock in the morning, going back to your analogy, who care about what they're doing and they're wanting to find out how to make this work. They're kind of the strong survive. It's the other ones who just give up and go like, I can't do this anymore. I don't want to do this anymore. You're cutting to the chase. They are out of the market and so be it. Because now the people who are understanding what's happening, who are credentialed, have credibilities, now you're dealing with the professionals and we're all going to figure this out together.
So just like we had subprime mortgage lending in the single family business, we had some, not a lot, but some in the multifamily business. But how it translated in the multifamily business, and Dusty, you can kind of give me your feedback too, is that we had a lot of people that were our tenants that were jumping out of apartment buildings trying to buy their first house because there was 100% financing available on the single family side. In fact, there was up to 103, 105, 125% financing on the single family side. And so these subprime lenders, whether they were the Ninja loans or the Nino loans or whatever, they were with a big vacuum taking a lot of our tenants out of these apartment buildings because it was cheaper almost to buy a house for these folks who had lived in some of these apartments since they were kids or whatever. And they had never really lived in a house, didn't really understand that when you were in an apartment building, you called the office and you had a maintenance person come up. Now, when their hot water heater went out at their house, they're the ones that were responsible for maintaining. They're the ones that had to cut the grass. They're the ones that had to pay the property taxes. And so when interest rates which were pretty flat earlier in, say, the early 2000s, all of a sudden started to go up because a lot of these subprimes were built on adjustable rates. A lot of them said, I'm done. I'm going to go back to the apartments. And so they gave back all these homes, and the apartment owners were like, where you get back in? All is forgiven. Come back into the apartment and get yourself a nice new unit, and we'll update it. In 2008, 2009, we had a tremendous amount of people that left the single families, got into the multifamily to be tenants back on these properties. They stopped building homes. A lot of people that went back across the border that were construction workers in Texas went back over to Mexico. They were doing their stuff. And a couple of years later, when the economy started to get better, they came back from Mexico, back into the United States, and they were out building new homes again. But tell me, walk me through 2011 and 12. How long did that trough last, in your opinion?
I'll get my calendar. I'm going to tell you that probably 2014 or 15, because there's always like this 2 or 3 year lag period behind it. To go back to the housing, the only good thing that happened when people were jumping out buying homes is that new construction on multifamily properties stopped. And typically what happened is the developers or the contractors, you could almost follow the dots. They would leave Texas and they'd go to Georgia. They would overbuild Atlanta, or they'll leave there and go to Phoenix, or they'd leave there and maybe go to the West Coast or something. So we're losing occupancy and people are buying homes, such as it were. You could see that the actual market change as far as new properties and the absorption rate. So that was kind of a good thing. We had a settled population as far as multifamily homes. When these things changed, and that's almost exactly what you're saying, Paul, is exactly what happened back in 88 or 89. When people were given their homes back, subdivisions, and we had a little division of our company back in the day with Sterling, these values were dropping 75%. And people who were trying to hang on to their property and didn't want to go back to an apartment and were trying to refinance their property, all of a sudden they bought a home, $75,000. The value now is $35,000, and they couldn't get a refinance because they owed $65,000. So again, the government comes into play here, and they kind of they change the table, they move the chairs on the Titanic for you. So when that started, of course, we welcomed them back. Come see us. You shouldn't have left in the first place, and we could be punitive. We could charge you more, but we're good guys in the real estate business. And they did, but yet again, it was probably somewhere 2012, 2014 before it kind of settled out. And I think the next one would be, moving on in the timeline, has been obviously going up to 2020, 2021, 2022. And of course, the big thing there was COVID. The government comes back in again and says, nobody can work anywhere. Nobody. What English is that? No one should work anywhere. You don't have to pay your rents if you're in the food and beverage business, so on and so forth again. And whether COVID was real or not, or whether somebody took a vaccine or not, this is not a political statement about any of that. But it was that kind of interference where we saw the same thing, where I tell the story. Just imagine if you were somebody going to close on a property on February 29th in 2020, and there was a 29th because that was a presidential election, leap year, and you were going to the title company the next day to buy your very first property, and 11 days later you were told that nobody had to pay rent at your property after you owned it for 11 days. How good did you feel about your investment?
Not good.
Not good. This is a patient business. I think for all of us who've gone through this, which is tied to the hope part, it is a patient business. This stuff doesn't happen in a vacuum, and it doesn't happen rapidly. And you can see it coming, and you can try to make all the adjustments that you can and start talking to your investors about, we may have to adjust our rents, we may have to adjust our what we're doing. It doesn't get paid. We don't want to paint it this year. We'll do it in partial, but it's a patient business. And if you do it to the level that like your group does, the professional, and you're patient, you will get through it, because the ones who are impatient, basically all they do for you is give you a better opportunity to buy a really good deal.
Yeah. So let's go back, talk about structure. And a lot of people don't remember this, but you and I do is that if you went back to the 1970s, 80s, even the 90s and going to the 2000s, it was like three rich guys and gals that would buy these properties in the B and C space.
Right.
And there was no syndication. So 90% were all the three rich guys or gals buying these properties. A brother-in-law, the rich investor to do it, and the management company would all come together and they would buy these properties. And then in, say, 2010, 2011, coming out of the great financial collapse, we started to see syndication models. And instead of having the three rich guys, it was the 90. It was the 110 guys that would join these syndication models, and they would all go out as a group, as a team, unaffiliated co-sponsors, unaffiliated equity providers. Nobody knew each other. There was one, I use the analogy of an airplane. There was one pilot and maybe a co-pilot leading the way, and there was a bunch of people in the back of the airplane that kind of knew where they were going, and they were just comfortable about putting money into these deals, and there was the fear of missing out, and they were drinking their Coke and having their peanuts, and they knew that sometime they were going to land with more money in their bag than they brought on board the airplane. Talk to me about what you saw from the three rich guys in the 70s, 80s, and 90s to the syndication models and the fear of missing out.
God, I want to go back to those three guys and a couple of gals if we could find them. Again, the industry, the profession had got more professional because it had to, going back to the 1986 tax change. So the three guys and the gal, if they had created wealth to do this, what they were to invest, they had a baseline of how to create wealth, how to manage money, how to operate a company, and so on and so forth. So the shorthand, the language was crisper. This is what we're doing. These are what your goals are. We understand what you're trying to achieve. It was, I think, better for everybody, from lenders all the way down to operators. You had a different conversation with people. When we got into the syndications, and I like your analogy of the plane, I have a little different one, but yours is better for review and recording. There's a couple of big groups here in Texas. You and I know the people who do that, who've done that in the past. And I like the fact that they're trying to educate people and mentor. But what we've seen is they have this 50, 60, 90 people or whatever it is in a process. And they don't know each other. They've not even had a peanut butter and jelly sandwich together, but they're all in this deal together because they're buying blocks, $25,000 blocks or $500,000 blocks or whatever the case is. And they're getting in the deal because they've heard this is the place to be. Well, I think we can agree that real estate is the place to be because this is our livelihood. We think it's a great profession.
Sure.
But when you get that size of group, every single one of them has a different morality or value system or need or whatever. And one thing that we're dealing with right now, I have a very successful property in Houston. We've had it for 16 years. The group has gotten all their equity back for years, all the capital, all the CapEx money, refinance it. We're distributing about almost $1 million a year still. They have no debt. So what's the return on infinity?
Yep.
But within that group, there were people now, because of 16 years, we have people who got in that when they were in their 50s, who are 65 and 70. Their goals have changed than what it was, 16 years ago. There's other ones who maybe got in when they were 35 or 40, and they're just in their mid-50s. They're good with the process. But the way it's structured is kind of like one for all and all for one. To take the people who want to get out, they want to buy out at today's market price, which is an exponential higher than when they bought it. And the people who are in it, maybe we're not that sure, but they can sell it to somebody else who they don't know. The deal is the dynamics of that group changes. And it's really hard, in my opinion, to try to meld all that together because there's just different goal sets. And so from the syndicator, really like, hey, we're all in this together and we'll all succeed together. To your point, we're all going to land safely. A little bit of turbulence here, but we're all going to land safely. Well, there may be somebody in that plane that needs to land sooner, or if and there's no amount of money that's insignificant, but if you're in for $25,000 and that's everything you've been able to accumulate for the last 5, 10, 15, 20 years, and you have something that goes bump in the night, like a roof gets tore off and your deductible is $200,000 and you need to have your capital called and your percentage is whatever that is, and you don't have it, it creates a lot of turmoil.
Those 2 or 3 o'clock in the morning.
That's at 2 or 3 o'clock. Yeah, wake up call.
Those decisions. So now we're in 2026, And we've been going through this for 2021, 22 or so. So we're into it for 3 or 4 years right now.
Mm-hmm.
When's it going to end? When are we going to fix this boat that has a hole in it? When are we going to get our sails full of wind? When is it smooth sailing again?
Well, I know you attend the same convention we go to in Las Vegas and San Diego, the National Housing Association deal.
Yeah.
It started out as we hit the floor in 24, survived to 25. It all gets fixed in 26. And I think the next one now is, we'll see heaven in 27 or something like that. The good news about all these pundits is the positive is ratcheting up. We went from the floor to it's going to get better, it's going to get a little better, and it's going to get a little better. And I think part that what drives not having too many of those 2 or 3 o'clock morning headaches is you've got to believe, and you've got to have that hope, and you've got to have patience. What's hit us all, especially in Texas, is, again, going back to the government and not making a political statement, is ICE. We're, to your point, especially in the San Antonio area, Houston for the most part, we have Latinos and other forces who work our fields and our shipping and this, that, and the other, do a great job. We need them. But they step out their front door, and as soon as they get off the property, they're gone away. I don't know. Are they illegal, or are they just there at the wrong time, the wrong day, wrong time, or whatever it is? But that's been a concern, and it's been a concern for even our owners who are wondering how many people of that descent, of that legal status, if you will, do we have on our property, and how many are going to leave and just go, and I have that vacancy.
Yeah.
And if that's a C class, B class property where the demographics is primarily Latino, Mexican workforce, blue collar workforce type housing, and it's affecting everybody, what happens to that area? That's been probably the most significant thing in the last 18 to 24 months, is that change and loss of demographics.
Yeah, that's been a big challenge in the B and C space in some of these large areas that are like Texas or Arizona or Southern California.
Absolutely.
And even areas up to Chicago, in Philadelphia, and in New York City, that these communities have been turned over. And so whether you're a tenant in these properties wondering if you're going to find yourself back in Honduras, or you're a landlord that owns these properties, that everybody needs some sense of stability about really what the game plan is and what can happen. Because a lot of these B and C properties that are tenant base is really the first generation of people coming over into the United States that are in our properties. We're always very concerned about immigration status, not just the tenants, but also the workers.
Yeah.
So the workers that work on these properties, whether it's a vendor that we have to hire to bring in to be an electrician, or the vendor that comes in to work on our HVAC system or our plumbing, can they get a license that has to be renewed? Do they have to show a good Social Security number to be able to get their license to do this business, renewed for another year? So it's just not the tenant. There's disruption in lots of these markets themselves. So let's kind of talk. Let's change the looking backwards. Let's look at kind of forwards right now. I mean, you guys operate, and we do a lot of financing in the B and C space. And these are properties that were built in the 60s, 70s, 80s, 90s, and then early 2000s. Kind of workforce housing, blue collar, kind of salt of the earth kind of tenants on these properties that probably AI will not affect these folks.
Probably not.
I would imagine. So tell me, across the normal typical occupancy in these properties has been for the last, say, 7-10 years, has been about 90-95% occupancy. In some of your properties, and again, there's always unusual ones, what is the normal today? What are we seeing for occupancy issues?
Mid 80s, probably the short answer is probably the mid 80s.
Yeah.
There's the outlier that's 95%. There's also the outlier that's, 68% because of demographics or because of the property or this, that, or the other. I see it getting better. I do. And I see it getting better because I pay attention to it. And I've got some great regionals and operators, vice presidents, operators. We're seeing it ticking up. I think one of the things that's happening, and this goes back to something that was at your conference last year that I really kind of gravitated to. We've done all the value add we could probably ever do. The next value add is we're going to resurface the tub for the third time or something like that. But now we get back to there's just the basics. We've got to go back to the basics in the business. The first one is location, location, location. That's the first thing. Where's the property? What are we doing with it? The next one, I think, is customer service. And we got so heady and so egotistical about that we could just lease anything anytime to anybody. We kind of forgot the customer service part of the deal. These are residents. This is their home. They invite guests to come be at our properties. So we have this contractual obligation to take care of the property. So if somebody moved, you're like, we'll replace it. We're 95%. We got a line out the door, good riddance, so forth. Well, all that's changed. And it's part of it's ICE, people going out the door. Part of it is the workforce has changed. I was going to add something to your conversation about plumbers and electricians. Because of AI, those are probably the most secure jobs on the planet these days.
You bet.
The ones who can do it are getting paid really well.
Yeah.
Gone are the days that you told somebody my daughter married a doctor, and it was like my daughter married a plumber. We're so happy, we're so excited about that possibility. But no, it's closing the back door, which I forget who one of your speakers said that last year. But it's closing that back door and getting back to customer service, retaining the resident at the property, and doing the red carpet or whatever we should be doing, should have been doing to keep that resident there. So I think it's a good retraining, relearning position that we're all in. And I know that hearing that from your group and knowing that it's homogeneous throughout the state. It's not just Dallas, it's not just Houston, it's not just Austin, it's not just San Antonio. We all need to do that. And that's going to make us a better industry. It's going to make it better for investors. It's going to make it better for lenders because you're going to see that constant occupancy of 92, 94. You're going to see rents going up because people want to be there. Think about how difficult it is to move. If I went home tonight and my wife said I need to move, and she probably should, but outside of that, I would try to do anything I could to keep from having to pack a suitcase. Right. It is painful and expensive to do that. So, I believe people move for three reasons. There's either a death or something in the family. You can't stop that. There's a change in jobs. You can't stop that. Or you make them angry. We can change that.
Right. And you guys are so good of really paying attention to all the needs of not only your ownership group, but obviously to the customer. The customer is the one that's paying their rent, hopefully on time. You try to give them an assist. You stay in front of them. You get the work orders completed. You get them to write positive reviews if you've really done the work on time and they're very happy with you, and then they stay. A lot of people forget the apartment industry is like one step above being in the hotel business. Mm-hmm. Is the hotel business, we have change almost every day. People come in, they change. We could have that too. We would just call it ourselves a Red Roof Inn. But we want to keep them as long as possible. We want to keep them not 12 months, not 18 months, but 36 months because the cost to turn the deal over to the new tenant. And you guys do such a good job. But give me some feedback of what gets a landlord fired these days. I mean, where do you draw the line and say, hey, listen, I just can't work with you?
I think that probably the most egregious, for all the reasons you said about the people who were there and the cost to move and change and so on and so forth. And in Texas, I think, if I remember, our average turnover rate in Texas is around 60% average. This is
on a yearly basis.
On a yearly basis. So 100 units, 60 units are going to go out. That's 5 a month. That's expensive.
Right.
And again, people don't want to move. It's expensive. It's time consuming. They don't want to move. Probably the most egregious is an owner who doesn't pay the vendors that help us supply the needs and the materials and the quality that property needs.
Right.
And there's, we're fortunate as Centra, we've, been in business for 40 years. I know you deal with other quality management companies as well, that a lot of times that vendor comes out there on our credibility, our credentials. Right. We're the credit, for lack of a better term. Okay. And, we take that seriously. Tina, who I think you met before, but she's our VP of operations. She sits on every apartment board known to man, Houston, Texas, Nashville, other states, I guess, wherever.
Yep.
And it's that kind of credentials and credibility that when we get a new owner or a new assignment, or we have an out-of-state purchaser, when we're asking for things to be done or get bids or do our CapEx after the closing, it's typically our credentials, having worked for Centra, knowing us, that we fight for our vendors, that we get that accommodation. When we lose that possibility, we lose that ability to do that. And when the owners take away the ability to serve the resident, that's one of those red flags you go, we've got to have a serious conversation, because a little bit selfishly, that affects our credibility and our credentials as
Yeah.
well.
I don't know how some owners are trying to chisel your fee down. They should be doubling your fee, because profitability is on the front lines, and Centra is on the front lines with the tenant, making the tenant happy or not making the tenant happy. That third piece, if you piss them off, they're going to leave. So make sure that the people on the front lines in the office, whether they're marketing or their leasing agent or the manager or the assistant manager or the management company, make sure they're all happy. Pay whatever their fee is, pay that fee. Second, always have money in your savings account and in your checking account. So when you do have a vendor comes in that needs to get paid, that it gets paid, because the next time there's a problem and Centra goes out to ask this plumber, can you go and fix this thing? Because it cannot be handled in the house. It's got to have a separate vendor do it. That vendor may say, well, that group already owes me $29,000. We're not doing that.
Yeah.
So, I mean, that credibility is not good. You don't want to be known as the guy. This industry is so small that you known as the guy that doesn't pay the management company, does not pay the vendors. All of a sudden, you're working that business yourself. And that's not what you want to do as a general partner. You want to do two things: find another property to buy, and to raise the capital. Don't manage these assets.
Yes, exactly. I mean, part and parcel of this is that we understand why the investors are buying the properties. I mean, it's a return on investment. It's wealth growth. That's the core to all the transactions. By the same token, when an owner says, well, I've got to pay a dividend this month to my partners, or those 99 people on that airplane, and we're not going to pay the plumber to go fix this, or we can't get somebody to come out and service the pool during the summertime because that's maybe our only amenity, because they haven't been paid. Yeah, I get the investment side. You invest, I invest. Those checks are nice.
Sure.
But when it's at the cost of operating the property and doing what we're supposed to be doing for the resident of the property, it just becomes an exponential problem. And I think it really goes back even a lot to the beginning underwriting, not from a lending standpoint, but when they're doing their basic underwriting of a property. You and I know groups that underwrite and they take things out to like the fourth decimal point. And if that fourth decimal point goes from a 4 to a 5, it's like, oh my God, this will never work. There's a little bit of humanity that makes this happen. And I jokingly tell the group that some guys that we do some investment in or we manage the properties with, they create this fantasy and we have to make it reality, that the end game. And somewhere between those 2 points is the actual humanity, the people that make that work. And I have a hard time understanding. The first thing they want to cut in expenses is let's cut our staff.
Yeah.
We need 3 maintenance men, but can we get by with 1? No, like, well, we got to try. No.
Yeah. Everything works on an Excel report for some of these engineers that become general partners and managing members in the deal. When you talk to the management company that manages the asset, who has the boots on the ground, that has other properties, you'll never get away with that type of stuff.
It's a people business. I mean, it's Excel spreadsheets and numbers and interest rates and cap rates and NOIs and IRRs. I mean, it's all of that. But at the end of the day, it's a people business. Common sense people business.
Keeping the wolf at the door. Dusty, what did I miss on our great conversation here that you think people should know?
From an investment standpoint, I think it's one of the greatest things that you could be part of. It's interesting. You meet some of the greatest people in these investment groups that you could ever meet. And it's, again, it's common sense. There's not a whole lot of calculus in this. So if you want to be something, you go out and buy gold if you like it, okay, fine. I think there's a little humanitarian part to buy a property and make it better for somebody to live in, and make somebody's life better. And at the same time, metastasize some growth and wealth for yourself and your family. So from an investment standpoint, I don't know of anything better unless you had an oil well and they're having issues too. From an operational standpoint, is to be redundant. It's a patient business and it's getting better and better and more professional by the time. AI is a big part of us. I think you and I had this conversation when we were in California not too long ago. I'm being drugged to AI by my grandchildren probably. And when I asked if I knew what AI was, I said yes, two vowels. That was my baseline, a year or so ago. But it is, again, it's a common sense, patient business, and you've just got to let it happen. If you think that you're buying a property and day one you're going to get a 10% cash on cash deal, then you got to look back at the owner and go like, well, why aren't you keeping this? Why are you letting me have this thing when it's going to flow 10% cash on cash? Why don't you just keep it and get the 10%? And you've got a lower basis point, to begin with. Let the professionals be the professionals. If you're an investor, stop working. Don't worry about getting up at 3:00 in the morning. Don't worry about the toilet that's overflowing. Don't worry about the body that was in the back of the building or something like that. Let the professionals do that. That's what we're trained to do, and we will do that for you. Be it Central Partners or someone else. When you start trying to be a property management company or an owner, and you're really not skilled set, you may be very skilled in investing, but I don't try to become a doctor. I don't go in and tell my cardiologist that he's wrong about what he wants to do to me. And I would hope that the cardiologist wouldn't tell me how to manage his property, because that's my business. That's my job.
So Dusty Wolf with Centra Partners Management out of Houston has been our guest today. He keeps the wolf away from the door. And so if people want to get more information on you and a little bit about what you do, Dusty, what's the best way for them to get in contact with you?
We have a website, centralpartners.com. My email address, if you'd like to contact me directly, is dwolf, DWOLF, that wolf at the door, at Central Partners, CentraPartners.com. And if you're watching this because my friend Paul has allowed you to see this, feel free to call me on my cell phone directly at 832-443-6955.
That's great. Dusty Wolf with Centra Partners. We certainly do appreciate you spending some time with us. Again, I'm Paul Peebles. Have a great day.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.